Hey everyone, welcome back to Corporate Decoder. Today we're diving into Conduit Pharmaceuticals' latest annual report, and let me tell you, it's a wild ride. This report is like a treasure map, except instead of gold, we're looking for signs of a company that can actually, survive. Will we find riches or just an empty chest? Let's find out. Conduit Pharmaceuticals is trying something new. A conduit to move promising but ignored drug projects from big pharma through trials and hopefully to market. Think of them as a matchmaker, connecting forgotten drugs with new medical needs. The company's big picture is pretty simple right now. They are focusing on developing and finding value in drug assets licensed from other pharmaceutical companies such as AstraZeneca. But before we get ahead of ourselves, let's first see the numbers. Let's check out their balance sheet. It paints a pretty clear picture. At the end of 2024, Conduit only had about $554,000 in cash compared to $4.2 million the previous year. That's a huge drop, and it shows how fast they're burning through money. Total assets also went down from $7.14.1 million. It is not good when assets go down that fast. Is there any good news? On the liability side, accounts payable, what they owe to others, jumped from roughly $215,000 to $1.4 million. So they are increasingly owing money to other people. Now let's look at the income statement. Not a pretty sight. The company lost $17 million, which is way more than they lost in 2023, when it was only $0.5 million. That is more than 3,000% increase, or 30 times more. The biggest increase came from research and development, ballooning to $3.3 million, mainly because of upfront payments to AstraZeneca to license drug assets. In short, the company spent a lot of cash on acquiring new assets. General and administrative expenses, the cost of running the company, also more than doubled to reach $12 million. It is probably related to becoming a public company. Here's another key point. The number of company shares used to calculate these losses more than doubled. The number of shares went from about 669,000 to almost 867,000. This happened because the company issued new stock, which dilutes the value of existing shares. Digging into cash flow statement, things are also concerning. They used almost $9.7 million for daily operation in 2024, compared to only $7.7 million a year before. This is driven by the higher net loss they experienced during this year. How did they finance the company? Well, financing activities helped a bit, mainly from issuing even more debt with $6 million. But again, this only delays the issues. So what is the plan to fix this picture? Conduit is betting that they can use existing trial data from AstraZeneca to potentially treat lupus and anxiety vasculitis patients. Also, they intend to use AZD5904 to treat idiopathic male infertility, but these are all still in very early stages and high risk, which is why Conduit only develops until phase 2 and attempts to license it to other big companies for royalties. The company's strategy involves establishing strategic collaborations with globally recognized KOLs, key opinion leaders, to collectively assess and determine the most appropriate indications for all our current and forthcoming assets. The company intends to use algorithmic and cybernetic technology services to enhance Conduit's decision-making processes and maximize the value of its pharmaceutical asset portfolio. Let's talk about risks, because there are plenty of them. First off, they are dependent on getting regulatory approval, and that approval is far from guaranteed. They acknowledge that any failure could lead to product liability lawsuits. Also, if they can't protect their intellectual property, their whole business model falls apart. And remember, most of their pipeline are still early stage, not approved to market. Here is one of the biggest red flags in this report. To cut costs, the company is trying to implement more algorithmic decisions. They have a related party is basically an entity or a person that has close ties with Conduit. So it may create a conflict of interest. The company hired them for $1.8 million to perform algorithmic and cybernetic technology services to enhance efficiency, lower costs, and accelerate timelines by minimizing human intervention. The problem is that Dr. Andrew Reagan, a director of Conduit, is also on the board of directors of Sarborg. That's a related party and potentially a conflict of interest. We have to ask whether this was the most competitive service or not. And here's perhaps the biggest red flag. Right there in black and white, it says, there is substantial doubt regarding our ability to continue as a going concern. We will need to raise additional funding. That's not exactly what you want to hear. The company is also having trouble maintaining minimum listing standards with NASDAQ, and they may be delisted. If our common stock were to be delisted from trading on the NASDAQ global market, it could cause the value of the common stock to decline. The The company plans to submit an application to transfer to the Nasdaq Capital Market, which application was submitted on March 7, 2025. They have a code of conduct that is good, but all this is a red flag to make sure that there is more focus on the team not messing up and complying with all the laws and doing things right. Finally, there's a patent dispute brewing. St. George Street Capital is claiming they're entitled to some of Conduit's patents. Conduit says this claim is BS and will defend it, but you know how these things go. It's going to be messy and cost money. They also warn that claims for indemnification by our directors and officers may reduce our available funds. To summarize the indemnification part, it basically means that directors and officers may ask for someone to pay for their liability, which in turn may reduce available funds. What is more, the board of directors has appointed an independent committee of the board of directors, the special committee, and delegated to the special committee the authority to review these matters and determine actions, if any, to be taken by the company. This can cost the company a lot of money. The auditor fees are also very high. The company paid Markham LLL for $341,000 for professional services. Also, we paid them audit-related fees totaling approximately $170